Okay, let's unpack this. You might have seen two bits of news lately, seemed kind of separate, but they really caught my eye.
Hmm.
First off, this company, they issue crypto stablecoins, right? They just listed on Nasdaq.
Yeah, just pause on that for a sec. I mean, a public company listed, dealing with the SEC and all that,
Right.
and it can issue what's effectively currency. That's a pretty big deal compared to how things usually work, governments or banks doing that.
It absolutely is. Feels like a shift. And then the second thing that felt totally different, Warren Buffett.
Ah, Berkshire Hathaway's latest report, mid-May, right?
Exactly. And it showed they completely sold off their city stock. Gone.
Yeah.
And cut way back on Bank of America.
Which for Buffett, I mean, he's Mr. Long-term, especially with banks.
Totally.
So pulling out like that, especially from Citi, which wasn't that old a position for him, it kind of screams he's not feeling great about banks right now, short term anyway.
Exactly. And here's where the source material you shared connects these dots. And it's fascinating. These two things, the stablecoin company going public, Buffett getting maybe nervous about banks, they seem deeply tied to a specific U.S. bill, one that looks like it might actually pass soon, the stablecoin bill.
Yeah, this proposed law, as the sources lay out, it could have just huge ripples, not just in crypto, which you'd expect, but like traditional banking, international money movement, even the U.S. debt situation. Big stuff.
So that's our mission for this deep dive. We're going through these sources, these YouTube transcript excerpts you found, and we're pulling out the absolute must-know insights. We'll unpack this stablecoin bill, where it came from, what's actually in this version, and the potential fallout, for stablecoins, crypto generally, global finance, U.S. debt, and, the banks.
We want to give you that core understanding of what could be a really game-changing piece of legislation.
Okay, so first things first, the basics. What exactly is a bill in the U.S. system? The source reminds us.
Right. Simple terms.
Yeah.
It's a proposed law, a draft. And for it to become actual law, it needs to get through both parts of Congress, the House, the Senate, and then the president has to sign off on it.
Standard procedure. Yeah.
And, this isn't the first swing at regulating stablecoins over here. The material mentions an earlier attempt back in 2020. The Stable Act came from the Democrats.
Right, I remember that. And that version was, wow, really different from what's on the table now. The key thing back then was only licensed banks could issue stablecoins, period.
Yeah, think about that. That would have been, potentially devastating for the existing big players like Tether, Circle, who aren't banks.
Huge blow.
And a massive win for the traditional banking sector, obviously. It could have totally reshaped the crypto landscape and maybe even stopped some of its growth.
So fast forward to today's bill. The material calls this one very friendly in comparison.
Much more accommodating to the existing structure, yeah.
Yeah.
But even this friendlier version hit a bit of a wall initially. Remember that Senate motion on May 8th? It got rejected the first time around?
Oh, right. Why was that?
Well, according to the source, the hang-up was about potential corruption. Fears that the way it was structured might open the door for, say, presidents or other officials to somehow control or improperly influence currency issuance. That was a concern raised.
Interesting. And, to really get why there's so much intense focus, so much money, and maybe even these corruption worries around stablecoins, you have to understand just how much profit we're talking about, the potential scale.
Yeah, the source uses a pretty striking story to illustrate this point. It connects to that big news about Abu Dhabi putting $2 billion into Binance.
Okay, I remember that headline. Looked like a standard big investment.
Right. But the source brings up this claim apparently made by Eric Trump at a conference, Token 2049. He supposedly said that the $2 billion deal wasn't just cash for equity, but it was settled using a stablecoin, one called USD1, which he apparently said was issued by the Trump family.
Whoa, okay. So how would that even work?
Well, the interpretation laid out in the material is pretty key to understanding the stablecoin business model. The idea is the $2 billion in actual U.S. dollars, the cash, went into the Trump family's bank account, the issuer's account. And in exchange, Binance got $2 billion worth of these USD1 stablecoins on their books. But the crucial part, the actual cash, the $2 billion, stayed with the issuer.
Ah, so they hold the reserves, and that's where the profit comes in, right?
Exactly. The legal profit, the material does the math. Take that $2 billion in reserves, put it into something super safe and standard, like short-term U.S. Treasury bills.
Yeah.
At current rates, that could generate something like $80 million a year in interest, legally.
$80 million a year just from holding the backing assets for the stablecoin.
That's the potential, yeah. And the source then draws this, let's say, pointed comparison. It contrasts that potential $80 million annual legal income
Okay.
with claims mentioned in the source about alleged total corruption by the family over a 4-year presidency, which the source pegs at around $30 million total.
Wow. So the legal income from just running the stablecoin reserve could potentially dwarf the figures associated with alleged illegal activities.
That's the comparison being made, yeah.
Yeah.
It's presented to really highlight the sheer size of the financial incentive here, why there's such a push, such interest, and maybe even why those corruption concerns popped up around who gets issued these things. The legal potential is massive.
Okay, that definitely puts the stakes into perspective. So with that kind of money potentially involved, let's look at what this bill might actually do if it passes. Let's start with the impacts the source sees as, well, maybe positive or neutral, the direct effect on stablecoins themselves.
Right, so the core rule is that these stablecoins have to be backed one-to-one, fully backed.
By what exactly?
By equivalent, very liquid assets.
Right.
The list mentioned is pretty specific. U.S. dollar cash, Fed notes, regular bank demand deposits, U.S. Treasury bonds, but only very short-term ones, less than 93 days to maturity. Also repos, reverse repos, under 7 days. Money market funds are okay if they only invest in these specific things. And central bank reserves. Pretty tight list.
Okay, so high quality, very liquid backing. And the source thinks the big guys, like Tether with USDT, Circle with USDC, they can meet this.
The suggestion seems to be yes.
Right.
It implies that while it's a strict standard, it's achievable for the major players currently. It helps them get compliant, get that regulatory stamp of approval.
But not all stablecoins would make the cut, right?
Definitely not. If your stablecoin is backed by, say, oil or gold or longer-term bonds, or if it's one of those algorithmic ones that tries to maintain its peg without direct 1.1 asset backing, those would likely be considered non-compliant under this specific law. It's really focused on USD pegs coins backed by safe, liquid, mostly U.S. government-related assets.
And this is where the source makes a really interesting leap, connecting it to RWA, real-world assets.
Yeah, the framing is quite clever. It basically says, look, this stablecoin bill, it's regulating assets pegged to the U.S. dollar or U.S. debt. That is a type of real-world asset.
Huh. Okay, I see the connection.
And so the argument goes the compliance rules being set up for these stablecoins could become a kind of blueprint, maybe a template, for how other RWAs get regulated down the road.
What are those key compliance rules again?
There are 3 main ones highlighted. First, monthly public audits, done by proper CPA firms detailing exactly what's backing the stablecoin. Transparency.
Makes sense.
Second, executive accountability. The CEO, the CFO, they have to personally sign off on these reports, attesting they're accurate, and if they lie, the source mentions potential jail time, real teeth.
Okay.
And third, third-party custody. Customer assets, the reserves, have to be held separately, accounted for separately. The issuer can't just dip into them or mix them up with their own company debts. Protects the user.
That does sound pretty robust, like building serious trust. So the idea is maybe tokenized stocks or bonds could follow this model later.
That's the prediction shared in the material, yeah. That if this framework proves successful for stablecoins, it could pave the way for a much broader adoption and maybe a real takeoff for the whole RWA sector because you'd have this clear regulatory path.
Interesting. Okay, zooming out even more then, what about the impact on the whole crypto industry?
Well, the source points to an estimate, supposedly from the U.S. Treasury Secretary, that digital currencies, stablecoins specifically, could eventually drive like $2 trillion into buying U.S. debt.
$2 trillion. How does that translate to the crypto market?
Think about the mechanics. If you issue $2 trillion in stablecoins, and they have to be backed one-to-one by things like treasuries.
You have to buy $2 trillion worth of treasuries.
Right, exactly. And where does that $2 trillion in stablecoin value likely go? The analysis suggests a huge chunk flows right into the crypto ecosystem, used for trading Bitcoin, Ethereum, DeFi, NFTs, whatever. It becomes the liquidity layer.
So compare that potential $2 trillion stablecoin base to what we have now.
Right. The source mentions the current total crypto market cap is maybe around $3 trillion, something like that. But it's only supported by maybe $200 billion in stablecoins right now.
So if stablecoins grow tenfold to that $2 trillion level,
the potential boost for the entire crypto market, fueled by this massive waves of regulated liquidity, could be enormous. It suggests a major potential growth catalyst.
Wow. Okay, shifting gears a bit, what about international finance, moving money across borders?
Yeah, the source draws a really stark contrast here between stablecoins and the old way, the SWIFT system.
SWIFT, yeah, the network banks use for international wires.
Right, and the material points out its issues.
Yeah.
It can be expensive, fees add up, and crucially, it's not 24/7. It runs on bank hours. The example given is like sending money from the U.S. to Thailand on a Friday.
You won't get there till Monday, yeah. Weekend delay.
Exactly. So the argument presented is that stablecoins, especially USD stablecoins operating on blockchains and now potentially backed by clear U.S. regulation and audits?
They offer a way faster, cheaper alternative.
Potentially, yes. Near instant settlement, much lower fees, operating 247. The prediction is this could lead to much wider use of stablecoins for things like international trade payments, remittances, stuff like that.
But what about oversight? SWIFT gives governments, especially the U.S., visibility into money flows. Do stablecoins lose that?
That's a key point in the analysis
Yeah.
because this U.S. regulation requires things like KYC Know Your Customer checks and those regular audits.
Uh-huh.
The U.S. can actually maintain a significant degree of visibility into how these regulated USD stablecoins are used around the world. So the idea is you potentially get the efficiency gains faster, cheaper, while retaining a lot of the surveillance capability that SWIFT provides. Kind of the best of both worlds from a U.S. perspective.
Interesting angle. Okay, let's talk about something that really surprised me in the outline, the potential impact on U.S. debt. How could stablecoins possibly help with that?
It seems counterintuitive at first, maybe, but the perspective shared is that a growing stablecoin market actually creates more demand for U.S. government debt. Well, remember the backing requirements. If stablecoins need to hold safe, liquid assets, short-term U.S. Treasuries are a prime candidate.
Right.
The source uses Tether as a concrete example. They've issued around $150 billion in USDT, apparently. And they reportedly hold about $120 billion of that backing in U.S. debt.
$120 billion, just Tether.
Yeah. That number alone, the source points out, makes Tether the 19th largest holder of U.S. debt globally, bigger than, say, Germany's holdings.
Wow. Okay, so the logic is simple. More stable coins issued.
Means more demand for U.S. Treasuries to back them. They become a built-in growing buyer base, helping to absorb all the debt the U.S. government needs to issue.
Okay, that makes sense. The source also mentioned something about the structure of who holds U.S. debt currently.
Yeah, it touches on how about 38% of U.S. debt is held internally, like by the Federal Reserve or other government agencies.
The whole left pocket to right pocket idea.
Exactly. The interest paid on that portion basically stays within the government system, so there's no real net cost.
So how do stablecoin issuers fit into that picture?
Well, the material views them, especially once they're regulated under this U.S. bill, as almost another form of internal or at least domestically aligned holder. Yes, the government pays them interest on the treasuries they hold. But unlike interest paid to, say, foreign governments, that money paid to U.S. regulated stablecoin issuers might be more likely to stay within the U.S. financial ecosystem. And the government could potentially claw some back through taxes on the issuer's profits, or maybe even fines if they mess up.
So it changes the ownership mix. More debt held by these regulated entities.
Potentially gives the U.S. government more structural control over its interest costs, and could, theoretically, improve the overall stability of the debt situation. It diversifies the buyer base away from just foreign countries and the Fed itself.
Okay, fascinating. Now, it can't all be positive, right? The material must cover potential downsides or negative impacts, too.
Oh, yeah, definitely. And the biggest potential negative highlighted could be aimed squarely at traditional U.S. banks. A major disruption.
How so? We touched on Buffett selling.
Right. So if this stablecoin market really blows up, we're talking trillions of dollars potentially. And if non-bank companies are allowed to issue most of these stablecoins,
Banks lose out on deposits.
that's the core fear. Why keep all your money in a traditional bank checking account, earning maybe nothing, when you could hold it as a stablecoin? Maybe it offers faster payments, integrates with crypto stuff you use. Who knows?
So people might just hold stable coins instead of dollars in the bank.
Exactly. And if that happens on a large scale, banks see their deposit base shrink. Massively, perhaps.
And less deposits means?
Less money for them to lend out. Their entire business model is built on taking deposits and making loans. If the deposit pool dries up, their ability to lend is seriously constrained.
And that's the potential disruption that might have someone like Warren Buffett rethinking his bank investment?
That's the direct link the material suggests, yes. This fundamental challenge to the traditional bank deposit franchise.
Okay, that's a big one for the U.S. What about negative impacts outside the U.S.?
Yeah, the source raises a significant risk for countries that already have, let's say, unstable currencies. It specifically mentions places like Turkey or Argentina as examples.
Why are they particularly vulnerable?
Because these USD stablecoins, they live on blockchains, often public, permissionless ones. which means, in theory, they could bypass traditional capital controls or foreign exchange restrictions that governments put in place.
So citizens in a country with really high inflation where the local currency is collapsing.
Could potentially just hop onto their phone, bypass local banking restrictions, and convert their failing currency into relatively stable U.S. dollar-pegged digital assets. These stablecoins become easily accessible.
And if everyone starts doing that,
The risk, as warned in the source, is that people abandon their local currency en masse. The country could effectively become dollarized, but through these digital stablecoins.
losing control over their own money supply, their economic independence.
Pretty much. Their central bank's policies become ineffective if everyone's using a foreign digital currency regulated by the U.S. It's a potential loss of monetary sovereignty.
Wow. That's a profound potential consequence. Okay, so bringing it back to the bill itself, where does it stand right now? What's the timeline look like, according to the source?
Okay, latest status mentioned was that the Senate motion, the one that failed initially, has now actually passed. So, progress there.
Good. What's next?
The material suggested a potential vote could happen quite soon, maybe within a week from when the source was recorded. Of course, it still needs to pass both the House and Senate, assuming it hasn't already by the time people hear this.
And then the president signs it.
Right. Presidential signature makes it law.
Mm.
But then there's a built-in delay. The source mentions an expected one-year adjustment period.
For issuers to get their ducks in a row, comply with the new rules.
Exactly. Get the audit set up, the
Yeah.
custody arrangements, make sure the reserves match the requirements. So if it gets signed sometime this year, the earliest it would likely take full effect is probably sometime 2026.
2026, okay. And the source had some speculation tied to that timeline, something about 2027.
Yeah, kind of an interesting, almost bullish take.
Yeah.
The suggestion was that maybe a widely predicted economic downturn around 2027 might not happen as expected.
Because of this bill.
Potentially. The idea floated was that the economic shifts, the activity spurred by this stablecoin regulation coming online, might be significant enough to counteract a downturn, maybe even fuel a rally instead. The analogy used was borrowing the east wind to sail thousands of miles.
Huh. So seeing this bill not just as regulation, but as a potential economic catalyst strong enough to maybe change the broader macro cycle.
That seems to be the implication in that particular speculation, yes. It underscores how significant the source views the potential impact of this legislation.
Okay, so when you really step back and look at everything we've unpacked from the source material, the potential scale here is just immense, isn't it? For crypto, for banks, for how money moves globally, even for U.S. government finance.
It really feels like it could be one of those pivotal moments, as the material suggests. We might be watching a fundamental restructuring of parts of the financial world play out.
It goes way beyond just, crypto regulation. It seems to touch on core aspects of financial power, monetary systems.
Absolutely. It seems to be positioning U.S.-regulated digital dollars potentially at the center of a future global financial system, operating alongside or maybe even challenging traditional structures.
Which leaves you, the listener, with a pretty big thought to chew on, doesn't it? Based on everything discussed here, stablecoins potentially soaking up trillions in U.S. debt, the risk of dollarizing other economies, the pressure on traditional banks.
Yeah, it really raises a fundamental question for the future. If a huge chunk of the world's digital money becomes these U.S.-regulated stablecoins, operating outside traditional banks, maybe ignoring national borders, how does that change the global balance of financial power? Seriously, what does financial independence even mean anymore for individuals or for whole countries in a world potentially dominated by stablecoins?